Hello, good afternoon, ladies and gentlemen. Thank you for joining our webinar on corporate tax in UAE, what you need to know today. I am Rachita Gupta, your host and moderator for the day. For those who do not know me, I'm a chartered accountant and working with KPI for last 2 years. Previously, I have worked with Video Chartered Accountant and EY India as a statutory auditor. Let us take a minute to understand why we chose this topic. I'm sure you all have read corporate tax and realize that couple of clarification is required in some places. While I'm sure cabinet decision and ministerial decision will be released soon to provide additional clarity, we decided that while we await their decision, we could start laying the groundwork, hence this topic. I'm sure this webinar will help us prepare for the implementation of corporate tax. This webinar today is divided into 3 parts. Part 1 is on transitional rules and way forward. This topic will be taken up by Mr. Rajgopal Pai. Part 2 is on transfer pricing policy. The speaker of this topic is Ms. Bhavya Bansal. And lastly, part 3 is on tax technology that would be taken up by Mr. Prabhakar Kamath, our managing partner. Furthermore, if you have any questions about this topic, please feel free to post them in the Q&A section along with your email ID so that in case time falls short, we can get back to you later. On that note, let me introduce you to our first speaker of the day, Mr. Rajgopal Pai. Mr. Raj is a chartered accountant with over 25 years of experience. He is heading advisory division in KPI. He advises clients on taxation, corporate governance and compliance, corporate advisory, etc. He was associated with Deloitte for more than 13 years before moving to Dubai in 2015. Over to you, Raj.
Hello and good afternoon and welcome to this webinar. The Federal Decree Law number 47 of 2022 on taxation of corporations and businesses is in public domain for over a month now, and I'm sure most of you must have read the law and had a chance to try to understand it as well. As Rachita had mentioned that the corporate tax is divided into 70 articles and it's divided into further 20 chapters. If you have read most of the articles and in the corporate tax require some sort of a clarification from the cabinet or from the minister. So while we wait for the cabinet decisions and the ministerial decisions, we thought it would be a good idea to discuss on the preparatory steps and the requirements and help you get ready for the corporate tax as well, well in advance for your respective first year. Before that, let me begin with the various dates associated with the corporate tax in the UAE. So looking at the timelines, we all know that last January, the Ministry of Finance releases a press release on corporate tax in the UAE. This was basically an announcement that UAE is coming into a UAE corporate tax regime. They also released frequently asked questions, and it was also published in the FTA's website. Then on 28th of April 2022, Minister of Finance released the public consultation document on corporate tax. The purpose of this consultation document was to seek suggestions from all the stakeholders. The deadline for submission of the comments on the consultation document was 20th May 2022. As you may be aware, we at KPI also submitted our suggestions on the proposed law, and we are pleased to share that few of our suggestions were incorporated in the published law. On 9th of December, the law was made public by the Minister of Finance. So when we got hold of this particular law, we came to know that the law was actually released by the minister on the 3rd of October. It was then published on the official gazette on 10th of October 2022. The law says most of the provision or almost significant part of the provisions would come into force from 15 days after the law is published in the official gazette, which is 26th of October 2022. However, one particular provision, which is very important on general anti-abuse rules, came into effect on the date the law was published in the official gazette, which is 10th of October 2022. Now, we know that the first financial year for the corporate tax in the UAE starts on or from 1st June 2023. And we all also know that we are yet to receive the executive regulation, and we expect it to be released soon. Before we go into further provisions or how to prepare for the corporate tax, let's try to understand what is the effective date and what's the first financial year for our businesses. As we know, the corporate tax is proposed to be implemented from the financial year beginning on or after 1st June 2023. The law says that the return has to be filed on or before 9 months from the end of the financial year of the taxable person. Which means if you follow 1st January to 31st December as your financial year, so for you, the first financial year will be period starting 1st January 2024 to 31st December 2024, and you have to file your return on or before 30th September 2025. Let's take few more examples. So suppose if you are following April to March as your financial year, your first taxable year will be 1st April 2024 to 31st March 2025, and you need to pay your tax dues and file your returns on or before 9 months from the end of the financial year, which in this case will be 31st December 2025. Likewise, you can see on the screen for other financial years, like October to September, if you are following, the first financial year will be 1st October 2023, and it ends on 30th September 2024. And 9 months after that, you need to file your return, which is 30th June 2025. Now, moving on to the topic of this presentation, Article 61 of the Corporate Tax Law deals with the transitional rules. Transitional rules, in a way, lays down the roadmap for the preparation of the corporate tax. What it says is that you need to have an opening balance sheet. We all know that most of our businesses are ongoing. So this provisions of transitional rule is largely applicable to the companies who are already registered or who will register on or before 31st of May 2023. So what is your opening balance sheet? All companies typically prepare its account at the end of the financial year. Normally, the balance sheet as at the end of the financial year is considered as the opening balance sheet for the following financial year, meaning the closing balances becomes the opening balances. It should be also prepared as per the applicable accounting standards, which is there in the UAE. So for example, again, just taking the cue from the last slides, if your financial year is from Jan to December, then the closing balance sheet will be as at 31st December 2023. So that means we are already in the last pre-corporate tax regime financial year for this particular financial year period. Likewise, if your financial year is April to March, then the closing balance sheet will be as at 31st March 2024. I'd like to bring to your notice that the minister may prescribe any other conditions or adjustments to the opening balances, which is not as now mentioned in the corporate tax law. As I also mentioned that the account should be prepared as per applicable accounting standards. We all know that UAE largely accepts and follows International Financial Reporting Standards, or IFRS. So how is this applicable? So all the mainland companies, they are following Commercial Companies Law, and Article 27, Subclause 3 prescribes the use of international accounting standards and practices for preparing the periodical and annual accounts. So IFRS is accepted as international accounting standards. Let's also look into some other free zones and what they prescribe. DIFC specifically prescribes IFRS to be followed by all the companies that are registered under DIFC. ADGM, on the other hand, requires individuals and group accounts to be prepared in accordance with the international accounting standards. Likewise, JAVZA also specifies that accounts should be prepared in accordance with applicable accounting principles or standards. So largely, IFRS in all the cases are accepted as international accounting standards. Just let's pause for a minute and identify or specify that most of the businesses may not be, there are few businesses who may not be actually preparing the financial accounts, or they are preparing the financial accounts as a management accounts without any accounting standards. For all those type of businesses, going forward, you need to prepare your previous financial statements as per the applicable accounting standards. One of the critical points also that needs to be looked into while preparing the financial accounts for the previous financial year or the last financial year pre the corporate tax regime is that of arm's length principle. What is arm's length principle? All the opening balances with respect to related parties and connected persons, if any, must consider the arm's length principle. Arm's length principle basically is the transfer pricing policy that is applicable for the related parties. We know that in UAE, there is no personal income tax. Hence, the government has also brought in connected persons, which we will discuss in maybe other seminars going forward. Transitional rules also imply that all transactions with related parties and connected parties during the immediately preceding year must be as per transfer pricing policy, which means if you are following Jan to December as your financial year, this particular financial year, which we are right now, 1st January 2023 to 31st December 2023, must be as per transfer pricing policy for all the related party transactions. My colleague Bhavya is going to take you further on the transfer pricing policy. The other important point that is the law carries in the transitional rules is on general anti-abuse rule. So what is general anti-abuse rule? GAR, as it is also known in the taxation parlance, is to avoid any transactions, avoid any undue advantage that a taxpayer can sort because of any restructuring or any type of transaction or arrangement it carries only for the purpose of saving the tax. What is in store for us in UAE? UAE law says that transactions or arrangements entered with the motive to obtain corporate tax benefits will not be allowed as a deduction or a arrangement. If it now, who is going to identify whether there has been any sort of a transaction or arrangement or restructuring of the business? The law clearly provides that it's the duty of the taxpayer to demonstrate that any such transaction or arrangement or a restructuring is not to avoid a corporate tax payable. It lies with the taxable person. However, FTA has the right under the law to make suitable adjustments if the taxpayer fails to demonstrate and levies tax on such income. What needs to be considered when we are entering into any such type of transaction or arrangement? One, the manner in which it was carried out, the form and the substance of the transaction or arrangement, the timing when it was carried out. This is specifically important because this particular provision of GAR came on the day the law was published in the official gazette, which is 10th of October 2022. What's the result of this outcome? Is there some sort of the profit that's generated and not paid tax on it because of the structuring or the way the transaction is carried out, or any changes or expected changes in the financial position of taxable person or the other person, whether it creates any rights or obligation which is outside the arm's length principle if it is carried on between two related parties or between the connected persons. So this is a very important provision, and this is already in force. So any type of transactions or any type of arrangements or restructuring that we are doing post the day the law was published in the official gazette, we need to be very careful on it and try to ensure that there is no sort of a undue advantage on tax point for the taxable person. So what we must do now, while we wait for the executive regulation, we suggest taxpayers start the groundwork for implementation of the corporate tax. So what to do now? The first step is to review the corporate structure. So we may have a group in UAE which has a holding company. They may have multiple subsidiaries with cross holdings or crisscross holdings. So you need to first identify, draw down your structure on a drawing board just to see how your structure looks like in the UAE. Why is this required? This is required for two purposes. One, to understand the ownership structure of the companies in the group, because if you try to create a tax group, you need to know that the parent company and the subsidiary together, directly or indirectly, own 95% or more in the other company to form a tax group. And second, to understand the flow of transactions within the group companies from the related party angle. The second part is identify and review the income stream. We need to identify where your income or sales are coming from. It could be from related parties and third parties. So we need to dissect our balance sheet, profit and loss statement to identify how much of our sales are from related parties and how much for third parties. This may be also required because if we form the tax group, so these related party sales will be nullified and we need to prepare a consolidated financial statements. So we will come to know what our cash flow situation is going to be looking like going forward. The second is how much of our total sales is from local sales and exports, because again, free zone companies, if they are qualified free zone companies and qualifying income, there will be a zero tax implication. Otherwise, you'll have to pay 9% corporate tax. Also, if our incomes include some sort of an exempt income, which is defined as per Article 22, including dividends and profits from other businesses, those are exempt, and we need to identify how much of the revenue contributes from this. For free zone companies, we need to identify the qualifying income and other income. We know that the qualifying income is yet to be defined or yet to be specified by the tax authorities, but we can still sort of do some sort of a groundwork considering the public consultation document also given us some indication of what could be a qualifying income. Lastly, I would suggest that if we are not already doing the reconciliation between income statement and VAT reports, we should start doing that right now, for the primary reason that FTA is the same authority for both VAT and corporate tax. Now, once we have identified and reviewed the income stream, let us now identify and dissect the expenditure. And why this is required is because Chapter 9 of the law specifically deals with these type of deductions, which includes deductibles. There are certain type of expenses which may not be allowed as deductions, and there are certain type of deductions which may have a limited allowance. Now, let's see what are deductible expenses. Any and all expenses which are directly incurred for the purpose of business or for generating taxable revenue are deductibles, and you can get deductions for the income for this expenses. The second part is non-deductibles. What are non-deductibles? Basically, any sort of a personal expenses of personal nature which is clubbed in the expenses, any fines and penalties, any bribes, any dividends paid, any withholding tax, which the non-allowed portion of withholding tax, donations to non-qualifying public entities, and expenditure incurred on earning exempt income. These all type of expenses will be non-deductibles and added back to the profits. And the last part is certain expenses which will have a limited allowance, largely interest and expenditure expenses. Entertainment expenditure, as we know, the law says 50% of the entertainment expenditure is allowed as deduction. The 50% will not. With specific respect to the interest, for interest expenses, we need to understand what our EBITDA is, and for any particular financial year, only 30% of the adjusted EBITDA will be allowed as interest expenses. So here, what does that mean? If it is more than 30%, what it means for us? No. Whether it will be disallowed or not allowed? No. Anything over and above 30%, you can carry it forward for the next 10 financial years to be set off. More clarifications on interest deductions and 30% or EBITDA is going to be expected in the cabinet decision, because cabinet is also going to apply a threshold of the interest expenses limit. At this point in stage, I would also like you to relook in and update your chart of accounts and accounting systems for these type of assets and liabilities, expenditure, which may be allowed, not allowed, partly allowed, and on the tax accounting system, Mr. Prabhakar Kamath, our managing partner, will be taking you further on what to be done and what not to be done on the aspect. Another point right now to do is analyze the benefits of group registration versus a standalone. We know that the law allows us for tax group registrations. And who can form a tax group? As we have already discussed, UAE company, parent company, which directly or indirectly owns at least 95% in the subsidiaries, can form tax group. However, all these companies should follow the same financial year and should follow the same accounting principles like IFRS or anything else. And none of the companies should be exempt or qualifying free zone company. Tax group will be treated as single taxable person. Means that if you are having more than one company, you will be treated as single taxable person, and the threshold of 375,000 dirhams will be applicable for only one as a taxable person. And lastly, while we are doing everything for the dissect and bisect of all these things, the training to the relevant staff is critical. So with this, I come to an end to my presentation, and I'll ask Rachita to take over. Rachita.
Thank you, Raj. That was such an insightful and meaningful presentation. I'm sure all the companies in UAE should start preparing for corporate tax, as the financial year for most of the companies run from January to December, which practically make this financial year as the last financial year pre-corporate tax regime. We also understood that one of the key requirements for corporate tax is transfer pricing, which means all the transactions with related parties should be at arm's length price. To educate us further on the arm's length price requirement, I would now like to introduce to you our second speaker of the day, Ms. Bhavya Bansal. Ms. Bhavya is a chartered accountant and a corporate and a transfer pricing expert. She has about 2 decades of rich experience in transfer pricing, international tax, and dispute resolution. She also holds an advanced diploma in international tax transfer pricing certificate from UK. In her previous role, she was heading the Global Transfer Pricing Center at a Fortune 500 multinational company. Over to you, Bhavya.
Thank you, Rachita. And thank you, Mr. Raj, for such an insightful presentation. I also got to learn so many things on the corporate tax aspect of UAE. I will share my screen now. So I'll discuss about the UAE transfer pricing regulations, what it contains, its applicability, the documentation requirements, and what we can do right now to be future ready or to be TP compliant in future. So as you are aware, the recently introduced UAE corporate tax framework also includes a comprehensive transfer pricing regime. Transfer pricing or arm's length principle means that the transactions between related parties and with connected persons need to be at a similar rate as if they are being undertaken between independent parties. So, simply speaking, it means that the transfer price between related parties should not be manipulated to shift the taxable profit base to a related entity or a connected person which is subject to a lower rate of tax. So the main idea of transfer pricing regime is to avoid shifting of tax base to a low tax jurisdiction. So, to give a broad overview of the articles which are contained in the federal decree law which relate to transfer pricing, I've listed the articles on the slide. So, Article 1, it gives certain definitions such as related party, connected person, meaning of control, etc. Then Article 34, it talks about the arm's length principle. Article 35, it deals with related parties and control. 36, it talks about payments to connected persons and when will they be disallowed. 55 talks about transfer pricing documentation. So we'll be discussing all these articles in the subsequent slides. Also, recently, there was a webinar which was held by the ministry. They have also clarified that the transfer pricing regulations will be broadly based on the OECD transfer pricing guidelines. Now, coming to Article 34, which talks about arm's length principle. So Article 34 says that arm's length principle means the transactions between related parties and the connected persons should be at a similar price or margin as it would have been for similar transactions between independent or unrelated parties. So just to give a very simple basic example, suppose there's A Limited USA, which is a parent company of B Limited in UAE. So A Limited sells, say, 1 kg of a product to B Limited in Dubai at 100 dirham. Now, the similar product is available in the market for 60 dirham. So now here transfer pricing provisions will kick in. A Limited and B Limited, they will be related entities because they are parent and subsidiary. We will discuss the meaning of related. So the transactions between them will attract transfer pricing. Now the price of 60 dirham, the price which is between the independent entities, will be considered as the arm's length price for the tested party transaction of 100 dirham between A Limited and B Limited. Now, to arrive at this arm's length price, there are certain methods which have been prescribed by the federal decree law. These methods are in line with the methods which are used globally and also prescribed by OECD. So the methods are comparable uncontrolled price method, resale price method, cost plus method, profit split method, and transactional net margin method. Now, which method is used will depend on a number of different factors, such as type of the transaction, the functional analysis of the transaction, the quality of the comparables available, the data which is available, etc. Now, coming to Article 35, which talks about related parties and control. So the term related parties is defined in a very broad manner. Related parties are categorized into natural persons and juridical persons. Under the law, parties to a transaction are considered related if they meet certain conditions. So the next two slides contains the conditions as prescribed by federal decree law. So for example, for natural persons, it says persons who are related up to the fourth degree of kinship or affiliation. This also includes affiliation through adoption or guardianship. Then if a person and their permanent establishment will be considered as a related party, then partners in an unincorporated partnership, trustees, founders, settlers, and beneficiaries of trusts or foundations and their related parties. So broadly, when a legal entity or individual has more than 50% of direct or indirect ownership or control over a taxable person, this falls within the related party definition. The law also defines control as the ability of a person to influence another person. So as a first step for a transfer pricing analysis, we would need to assess who all are the related parties and identify the transactions between them. Now, the law also gives the meaning of control. So control has been categorized as having a 50% or greater share in the voting rights of another legal person, being able to determine the constitution of 50% or more of the board of directors of a legal person. So for example, if A Limited can appoint 6 directors out of say 9 directors in B Limited, then they both will be considered as related parties. Being entitled to 50% or more of the profits of a legal person, having the ability to exert significant influence over the affairs and business operations of a legal person. So an interesting point to note here is if you see the first 3 conditions, there is a threshold given of 50%. However, in the last one, it becomes a very subjective category. Now coming to what is a connected person. So the regulations, they provide for disallowance of payments to connected persons if it is not at a market value. So a person will be construed to be connected to a business if the person meets at least one of the following conditions. An owner of the business, a director or an officer in the business, a related party of any of the above. So the meaning of related parties and the connected persons is very wide and will need to be analyzed on a case-to-case basis for application of transfer pricing provisions. Now, coming to some examples of the transactions which will come under the purview of transfer pricing are, say, ABC UK sells goods to its subsidiary, to its, say, 100% subsidiary, ABC UAE. So the transaction, any transaction between ABC UK and ABC UAE will be subject to transfer pricing because ABC UK and ABC UAE will be related entities. Another example can be A Limited US appoints 6 out of 8 directors of B Limited UAE. So they will again become related parties. So say provision of software development services from B Limited to A Limited will attract transfer pricing provisions. Payment of royalty between any 2 related entities. Interest on loan between 2 related entities. Then an example of a connected person would be a managing director of a company. So a payment of his salary would attract transfer pricing provisions. Now coming to the documentation requirements. So globally, there is a 3-tier documentation requirement which is followed in transfer pricing, which is in line with the OECD guidelines. There is also a disclosure requirement which again most of the countries they follow. So there is a form which goes along with the return. Similarly, UAE also has come up with these 4 requirements. So first is the disclosure requirement. So a disclosure form will have to be filed with the tax return. This will have basic details on the taxpayer, a broad overview of the international transaction or the connected party transactions of the taxpayer, the method used for each transaction. Though the form has not yet been notified, then there is a requirement of a master file. So, as per the OECD and other country practices, a master file provides a global overview of the enterprise's transfer pricing. It includes a high level information about the company's global operations and transfer pricing policy. Again, the exact details are not yet available. We are waiting for further clarifications from the ministry. Then we come to the TP report or the local file. So, the transfer pricing report, this is the document which identifies the transactions with related parties or connected persons. It has a detailed description of the transactions, functional analysis, industry overview, economic or benchmarking analysis. The benchmarking analysis involves determining whether a transaction is at an arm's length or not. It involves financial analysis and use of databases or other appropriate sources for identifying the comparables. So now again, the thresholds for when to prepare the TP report has not yet been notified. However, the law does say that TP report and the master file will need to be filed within 30 days after the tax authority calls for it. Now then we come to country by country reporting. So CBCR, as it is commonly called, requirements are already applicable to the UAE headquartered multinational groups with financial reporting years starting on or after January 1st, 2019. However, CBCR requirements are applicable to very large MNCs with total consolidated revenue that is equal to or more than AED 3,150 million for the financial year preceding the reporting year concerned. So as I mentioned that there are no guidelines as yet for when we are supposed to, what form we have to prepare the master file in or the disclosure requirement. There are no thresholds which have been prescribed. However, the requirements will be broadly aligned with OECD standards is what we understand. Also, the FAQs do state that businesses which claim small business relief will not have to comply with the transfer pricing documentation rules. Now, coming to an important aspect of this discussion. So, what we can do right now to manage our future transfer pricing compliance related risks. So, a transfer pricing policy is a document which we prepare in advance of the year. So, it is a pre-facto analysis. So, this document is very similar to the transfer pricing report, which will be prepared after the year. However, transfer pricing policy will be prepared in advance of the international transactions to determine that what is the arm's length compensation which is expected from a transaction. So this will help in structuring the business, which will comply with the transfer pricing requirements. So a transfer pricing policy will identify the transactions with related parties or connected persons, will have a detailed description of the transactions and their functional analysis, economic or benchmarking analysis. So a transfer pricing policy ensures that everyone within the firm is on the same page. Moreover, it demonstrates that transfer pricing has been considered and implemented correctly, creating a record for internal as well as external stakeholders. So a transfer pricing policy will lay down the multinational's policy regarding the application and implementation of transfer pricing rules and help the tax and the finance department to ensure correct pricing. Now, coming to the objective of a transfer pricing policy. So the question arises, why a transfer pricing policy? So the objective can be explained in two words, harmony and compliance. So a transfer pricing policy will ensure harmony. So it will ensure that everyone in the firm is on the same page when it comes to the transfer pricing arrangements. So let me give you an example. Suppose the finance department wants to know what amount to charge to which group entity and when. The risk department wants to ensure that transfer pricing arrangements do not create risks. And the manager wants to know whether his or her financial results are affected. So the TP policy will help all these departments to ensure their respective goals are met and to give them some direction. Then it also ensures compliance. It will help to demonstrate to the tax authorities that transfer pricing has been considered and implemented the right way. It shows a proactive attitude, which is highly appreciated by tax authorities. It will set you apart from the other similar businesses. So, to give an example, during a tax audit, tax authorities normally check whether compliance requirements are met. Besides showing the customary transfer pricing report, it will also be a very big value add and a powerful document if the multinational can show exactly how the transfer pricing arrangements have been implemented and are being complied with and how they've been arrived at. So it is highly important to have a transfer pricing policy in place as soon as possible. Now, coming to a few questions that we have in mind related to transfer pricing. So, first question that I've put on the slide is: will transfer pricing rules apply to both domestic and cross-border transactions? So, the answer to that is yes, it will apply to both domestic as well as international transactions. So, transactions between free zone entity, mainland entity, then payments to connected persons, transactions between exempted persons. So all these will be examples of domestic transactions on which transfer pricing rules will apply. Then they will also apply to international transactions between related parties in different countries. So what next question is, what kind of transactions and arrangements are covered within the scope of UAE transfer pricing regulations? So the simple answer to this is the transactions between related parties or connected persons. So it is very important to determine who all will be our related parties or connected persons and what all transactions are being undertaken between them. Next question is, when can we say that transactions and arrangements between related parties or connected persons meet the arm's length standard? So the answer to this would be if they are at the same rate as similar transactions are undertaken between independent parties. So to arrive at this arm's length standard or the arm's length rate, a proper benchmarking analysis or a transfer pricing policy report will have to be prepared. Next question, how should we determine the arm's length result of a transaction or arrangement between related parties? So for this, we would need to do a proper transfer pricing benchmarking analysis to find out comparable prices between independent entities. So more guidelines are expected from the FTA on this. Now coming to the last bit of the transfer pricing presentation. So what we must do now. So most important would be reviewing the intercompany arrangements, determining who are the related parties and connected persons, determining the transactions to which the transfer pricing will apply, then preparing a transfer pricing policy to ensure that the intercompany transactions will meet the arm's length standard in future. So with this, I come to the end of my presentation. Over to you, Rachita.
Thank you, Bhavya, for beautifully describing transfer pricing requirement in such short time. I know if time permit, you could speak hours and hours on this topic. But since we have limited time, I would now like to proceed to our next topic, which is tax and technology. Can technology and tax be married and live happily ever after? Are corporate tax and technology compatible? To know more about how the two can coexist, I would now like to welcome our third speaker of the day, Mr. Prabhakar Kamath. Mr. Kamath is a founder and managing partner at KPI. He is a FCA and CFA chartered holder with over 35 years of experience in corporate finance, audit, process design, etc. Under his guidance, we signed with NetSuite as a solution provider in 2014. And since then, we have successfully implemented NetSuite for several clients in various regions, including USA, Saudi, Muscat. Last year, KPI was awarded as the top performer of the year. On that note, I would now like to welcome Mr. Prabhakar Kamath.
We are all preparing for the UAE corporate tax regime. Understanding the law, understanding the rules and regulations is the first step. At the same time, it's very important that we also understand the technological aspect of the requirements. One second. Some of the most frequently asked questions coming from everywhere is as follows. Do I need a new software or an upgrade or a tax engine, or do I need a plugin? Is my current software good enough, and can I modify it or customize it to comply with the requirements? Is our current system is good enough that can be customizable for the tax requirements? These are some of the questions. Hi everyone, I'm Prabhakar Kamath, Managing Partner in KPI. In today's session, I would like to answer some of these questions, and we are planning a series of webinars to answer most of the questions related to taxation and technology. So what will be covered in this session? I will cover the practical aspects of comparison of tax software for direct tax and indirect tax, the system changes and redesign that is required for complying with corporate tax, and we will take two practical examples for UAE corporate tax. And what I am not going to cover is, we are not going to cover the requirement for transfer pricing. I'm not going to talk of heavy stuff like technology stack, platform, and so many other requirements, because the tax software and tax compliance software is much more easier than it is made out to be or it is perceived to be. And we will not talk of any particular software. I'm not going to promote or I'm not going to endorse any particular software in this session. Now, 5 years back, VAT was introduced and we all prepared for the UAE VAT. At this stage, it is a good idea to compare the software requirement for VAT and corporate tax. So these are the activities any organization will do. In terms of transactions, you do sales, purchases, expenses, and payments. These are the major items which generates VAT activities, either VAT output or VAT input. So what it meant for the systems? It meant that the data entry screens, the forms and user interface have to be customized. How it goes to the general ledger have to be customized. With respect to products and item master, whether it is items, services, raw materials or components, we required major changes in the masters, which required major changes in the master and the rates that is to be captured. About the place of supply requirements, there was various requirements which required several changes in the masters, forms, and user interface. And the frequency of report, VAT was either monthly or quarterly. Basis of calculation, the VAT is always net of input and output VAT. Now, before we go into the comparison, let us see how corporate tax is calculated. It starts with net profit as per the income statement. And we will add back all the expenses which are disallowed. Say, for example, as per the UAE proposed CT law, the input VAT which is unclaimed is to be added back. Like that, there are several items is to be added back. We'll take it up one by one during later sessions. Today, I will cover unclaimed input VAT. And then you will also add back partly disallowed expenses. And minus the qualifying income or income attributable to free zones which are qualified income. That's how we arrive at the taxable income. Now let us go back to comparison. In terms of sales, purchase, or expenses, there is very minimal requirement or minimum changes in the data entry screens that is expected to happen. However, for payments, if there are withholding taxes, currently withholding tax is set to be 0%, but if there is a withholding tax more than 0%, then the payment process will undergo some changes. With respect to products and items, we do not expect much changes in the masters or the rates, because corporate tax is one or two rates depending on the slabs, which is applicable only after calculation of income for the year, taxable income for the year. And segment reporting related information will come from general ledger. And regarding the place of service, place of supply, information related to free zones only need to be captured that at this stage we do not know. We are awaiting for the tax regulations. Frequency is yearly. Basis of calculation, as we have seen, it is annual profit plus or minus. So how these additions and deductions are to be done or obtained? See, most of the information will be obtained by restructuring the chart of account, designing the process to capture the report and required data, and some changes in the custom form, customization of the forms and user interface, adding certain fields, adding certain flags for the transactions may be required. So now let us take one example for unclaimed recoverable VAT. So when we pay a vendor or when we book a bill for payment to the vendor, prior to the corporate tax, if there are certain companies, many companies, as a matter of policies, don't claim the VAT on small amount of expenses. For whatever reason, they don't claim. So what are the implications? For the corporate tax, as per the proposed law, any unclaimed VAT which could have been claimed is not allowed as deduction for corporate tax. That means the way we enter the transaction will change. Option one for the companies is revisit the policy and enter and claim the VAT. And if some reasons you do not want to do that, then you will forgo the VAT payable or VAT paid. You have to debit only the net amount to the expenses and debit the VAT unclaimed to a separate chart of account and you cannot claim it. This will be added back to the profit for the year. Software changes, creation of a new chart of account, and making sure that in the data entry form, the second line is for this new account created. Second example I am taking is on withholding tax. So payments transactions, especially payment related to overseas vendors, will undergo change. Before corporate tax, you used to enter the payment in the normal way, but post corporate tax, you have to pay to the vendor only a net amount, total payable minus the withholding tax rate, which currently is set to be 0. We await the loss. If the tax rate of withholding is more than 0, you will deduct and pay the balance to the authorities. So what are the software changes required? The vendor master is to be updated for the rate. If it is, it can be updated on country-wide basis depending on the withholding tax rate. And the payment process will undergo a change in the sense that the transfer pricing, payment withholding will be withheld. The entry is to be made automatically. The posting is to be done to the general ledger automatically. So there is going to be a change in the form for bill payment. Now, coming back to the corporate tax calculation, as you can see, most of the transactions, most of the additions and deletions are for partly allowed or fully disallowed expenses will come from general ledger or search transactions. If the data is flagged properly, if data is debited to the proper chart of account, this information will be obtained. And since this corporate tax calculation is once in a year and not very frequent, it is most likely that this calculation will be done outside of the software. It will be done in the Excel, using Excel or something like that. So I believe that there may not be a customization required to get this report automatically from the software. Now, coming back to this, is your system ready to make these changes? It depends on type of software. If you are using off-the-shelf software, off-the-shelf accounting software, then vendor has to upgrade and provide you with the new version. However, if you are using ERP with a database access for the backend, and you can create the form or modify the form which are provided by the vendor, the changes can be made either by in-house or through consultants. So that's what is about the corporate tax software. It's not as complicated as it made out to be. We all should be ready by the time laws are introduced. And this is our attempt today to take 2 examples. In the coming session, and as law is introduced and we know more about the requirement, we will handle and we will do more webinars on some of them. Thank you very much.
Hello, everybody. I think we have received some questions. So let me take that up. So the first question I can see is from Jade. Can we have a summary of this webinar? Yes, video link will be available on our website, and we'll also share a handout later on. One question is there from Alex. We have many companies in the UAE, and mostly all the companies are owned 100% by BVI holding company. Can we create a tax group for corporate tax purposes? So as per the law, which is out right now, we know that you can create a corporate tax group for corporate tax purposes. But in this particular case, you need to create a holding company in the UAE, which will in then turn hold 95% or more in all the other companies. Only then you can create a tax group. In this particular instance, since all the companies are held by BVI holding company, you cannot create a tax group. Another question from April. For companies exempt from corporate tax, such as ADGM registered companies, are they required to register for corporate tax and file nil returns? Yes, you are right. The law requires all the companies, mainland and free zone both, whether they are qualifying free zone companies, everyone needs to register for the VAT, for the corporate tax purposes, sorry. And if you are have mostly exempt income, or qualifying income as per the free zones, then you need to still file a return, which will be a nil return. But registration and filing compliances is required. Next question is from Roshni. We have one company in UAE, which is registered with Dubai DED. We have export sales and local sales. If we set up a new company in free zone for the export business, will this be considered as anti-abuse? Roshni, before you decide to go about with this type of restructuring, you need to ensure that you are not trying to actually do this particular type of restructuring for the purpose to avoid any paying of corporate tax. But if you can demonstrate that it's a commercial valid reason, then yes, you can still go ahead even after the anti-abuse provisions are in force, which is from 10th of October. So you need to justify why you are doing that, and if FTA allows, you can just go ahead and for the free zone company, if it is with under all the incomes are qualifying income, then you can pay 0% on that income, and for your mainland company, you can continue with 9%. And the question is from Viren Bhatia. Can an individual having consultancy business pay salary to himself? Will that be disallowed entirely, or will it be allowed if an unrelated person would have earned the similar salary? Not the entire portion of the salary will be disallowed. There is a concept of connected person here. Bhavya, correct me if I'm wrong. So
Yeah,
there
yes.
will be sort of,
Yes, yes.
you need to benchmark yourself, as your second part of the question says, that, if you're paying the same amount to an unrelated person, then yes, your entire salary will be allowed as deduction. But, Ministry of Finance is yet to come out with certain type of clarification with respect to related party transactions. Bhavya, if you want to add on anything to that?
Right, I'll add a little bit. So what the regulations right now say, they say that payments to a connected person shall be deductible if the following conditions are met. So they've given two conditions. So they are saying it corresponds with the market value of the service provider, of the service provided. So what you have asked, that if similar salary is being charged by independent parties, okay, so that will be the market value. And then second condition they are saying is that it is incurred wholly and exclusively for the taxpayer's business. So the main point is that it does say that the payments to connected person shall be deductible only if these two conditions are met. So further clarifications are still needed from the ministry, that whether the full amount will be disallowed or only up till the market value, or so. Yeah. Over to you,
Okay.
Raj. Yeah.
So the next question we have is, do I need to have a transfer pricing policy even if I do not have a related party transactions? I think Bhavya has responded to that, but if you want to go ahead, Bhavya, please.
So I just wanted to add to this that we have the concept of related party transactions as well as payments to connected persons, for which transfer pricing will apply in UAE. So therefore, if we feel that we do not have related party transactions, we also need to review whether we have connected party payments or not. So it is better to do a proper analysis and then conclude that whether we have related party transactions or not. Yeah.
The next question is from AP. Are there any resources or guidelines available for companies to better understand and comply with corporate tax laws in the UAE? Our website will come out with some short sort of question answers and FAQs for various topics. You can also find these type of material on the Ministry of Finance's website. If you still need any understanding, we are there to help you. You can reach out to me or anybody in KPI, and we'll be there to help you in this. There are more questions, and I also have their email IDs. So, I'll take this down on the emails offline, one-on-one, because we had budgeted on 1 p.m. and we value your time. So thank you all for your attendance, and look forward to you all having you all on the next webinars going forward. Thank you and have a lovely day.